38 years ago today, it's March 25th, on 1988, the entire life insurance industry was rocked. Whole life insurance completely and totally changed. So what caused it? Crappy marketing. Now, a single newspaper ad in the Wall Street Journal had Congress calling hearings and putting the whole industry essentially under a microscope. Now, today, in part 2 of our solo deep dive into this book, The Perfect Investment, I'm going to walk you through a little bit about what all happened there. And we're going to jump right ahead into chapter 4. The chapter is called IBC Is Not a Gimmick. Now, let's expand on this. We're going to unpack the real history a little bit that caused the whole life insurance industry or the whole life product to get a bad name over the last 4 years. Why exactly did it fall out of favor? And why is it now coming back full steam in 2026? I think we have something to do with that a little bit. Now, we all know the history basically has a way of repeating itself, all right? Especially when hype and clickbait things show up on TikTok, or as we say, the TikToks, the Instagrammies, and the YouTubes. But let's get crystal clear on what actually happened. And why is the core concept of IBC and whole life insurance still rock solid today? So we're going to jump into chapter 4. We already covered chapter 1 in one of our last videos. And we spent a lot of time talking about how central banks keep tricking us into the boom bust cycle, a little bit about unpacking that, about the importance of having that control and autonomy, but also what are the characteristics of a perfect investment and what would you check off on all those things? And then additionally, the impact on how by choosing to kind of secede, unplug yourself from the traditional system and plug yourself into a system that's connected to an insurance company who can't inflate the money supply, how you become part of the solution instead of part of the problem. All right. So now we get this question again, IBC, the infinite banking concept. It sounds too good to be true. Is this just a gimmick? We hear things like this all the time. People who are just discovering it. And maybe if you're already doing this, you might have went through your own version of that discovery process. I know when I first got the book, I had suspicions. I'm like, this makes a lot of sense to me, but I need to confirm. I need to verify some things. And everyone should have that degree of healthy skepticism. That's important. But what's also important is that you don't just stop and pass it off. You go through and you do that final step. You get the information you need by listening to content like ours or reading good books like this so that you can be in a position where you're actually making good decisions based on real information and real data. Okay, I think that's the right way to go. So we're going to dig into chapter 4 a little bit here. Now, this all really began and started in 1987. And for the purpose of what we're focusing on, we're going to talk about the American side of things for the USA. And I'm going to pivot in some of the Canadian elements as well. But I'm going to go right to page 33. And it opens like this. In 1987, April 1987, a newspaper ad in the Wall Street Journal with the following title, the unbelievable bold headline: all life insurance lets you provide for your children. Ours lets you buy toys of your own. Bold statement. This ad was so ostentatious, which is a great word, by the way, in its message that it became Exhibit A in a Senate hearing before a subcommittee on taxation and debt on March 25th, 1988. So here I am recording this totally by accident. I actually meant to record it yesterday. And I came back and I looked at my notes. And I'm like, oh, wow, I'm recording this on March 25th. And we are literally 38 years down the road from when this happened. Quite interesting. Now, the final outcome of these proceedings led to a dramatic change in the IRS code and the treatment of insurance, unmatched by any other since the insurance industry's inception. All right. Now, here's a cool thing. Next paragraph says, even our common sense, not as common these days as it used to be, tells us that this advertisement in the newspaper article is definitely talking about special benefits for the living, not the dead. So that the ad does raise the question, is this really life insurance? So consider that for a second. We often get these questions from folks who are wondering, well, how is this possible? Why is this possible? Why are the insurance companies let you? Why are you able to do this? Well, there are rules and there are limitations, and those rules and limitations are based on, for the most part, something that we would refer to as tax-exempt guidelines. An insurance policy, an insurance contract has to maintain being an insurance contract. It can't be something else. It can't become an investment vehicle. because it's under a different guidelines, rules, regulations, and so forth. And so the end result of an insurance contract is that the death benefit, whatever that is, has to have merit. So if you're the insurance company, just imagine for a moment, put yourself in the position of being an insurance company and you're someone that works there. You're an underwriter. You're deciding, should we insure this person? Should we not insure this person? Maybe that's your role. Well, you have to follow rules, and those rules have to make sense. So one of the things you're looking at as an insurance underwriter is when the advisor submits the application or the case that we're looking at, the death benefit that we're solving for, that number, does it make sense? Is it reasonable under the circumstance? How old is the person? How much money do they make? Should they be able to have this much death benefit based on their income? What about their assets? What are we solving for? Oh, we're solving for an estate benefit. Okay, estate taxes. Well, we only need so much to solve that problem depending on the person's situation. And again, what's the age relevant? So there's a lot of these factors, and it has to fit into this bubble that makes sense to the insurance company. If it's outside of that bubble, they'll just say, we're not going to issue this. It doesn't make sense for the circumstance. So the insurance contract itself has to stand on its own legs, its own 2 feet when it's presented in front of the insurance company. That's really important to understand. And ultimately, no one is supposed to get or create or generate wealth. Let me rephrase that. The purpose of insurance is to be a replacement of a loss of income, loss of money to estate taxes, loss of some nature. And we're solving for that loss. So its purpose is to replace the loss, not to make you wealthy. Now, if you have access to the tool by using things like policy loans and collateralization, could you use that access of capital to go and build wealth in other places? The answer is yes. Like I talked to someone today who was doing that, borrowing to put something into a non-registered account for a long-term dividend passive income portfolio. Literally had a conversation like one of those today. So lots to unpack here. Now, when we go back to our article, again, this all started in 1987 with this ad. And if we think about how kind of, in your face that ad was, that would have been the equivalent of kind of almost clickbait marketing. Now, look, it was bold. It basically shamelessly bragged about the living benefits and not the death benefits. It was talking about toys of your own while you're alive. We know that that's not what we're supposed to be promoting, but we see things like that today. That's the same stuff that's happening right now and for the last couple of years. So it's okay to agree to a degree, but at what point are we going too far? Now, back in 1988, you couldn't click a newspaper page and open up a website. But today, the news is online. Ads are everywhere. And there's literally clickbait that's taking you basically straight to a YouTube page or whatever. And it's bringing you to someone's channel or it's taking you to their TikTok page. So the same thing that's going on in social media, these bold statements we're seeing today, like, oh my God, you can make money buying cars. Well, we've talked about that a number of times. Jason and I have mentioned this. This is the type of stuff that we're seeing and our colleagues are seeing out in the industry. You're not making money buying cars. Look, if you're a car collector, if you're a mechanic who buys, fixes, and flips cars, or you're a car dealership, sure, totally get it. Yes, you're probably making money buying cars. But if you're, Joe Average, and you get a car and you drive it into the ground and you watch it depreciate, it's got the dings, the dents, and all the scratches. That person, which is the bulk of the human population, they're not making money buying cars. They need the car and the fact that they have one so they can get from A to B for their business or they can get to and from work. It allows them to be able to earn an income, but the car itself isn't making them any money. So that's a very different story. But yet we're seeing the marketing and the clickbait stuff out there that's trying to make something into something it's not. It's making it sound better than it is. It's giving people a false sense of interpretation on what an insurance policy is going to do for them or what this concept is going to do. And it also makes people think, oh, I don't really have to do anything at all. I just go and get one of these and magically I buy cars and everything works out in the long run. That's just not true. You need to focus on your behavior and your mindset, and you need to take very clear and specific actions as the banker in control of your life in order to accomplish and see the results that Nelson talks about and shows us it's possible in his book. That is very different. And that's really what I see when I get to chapter 4 in this book. Now, we're not talking about these crazy claims where you fund a premium and everything just grows like magic. Sure, policy's going to grow. You can't just borrow willy-nilly and never pay it back. No, you have to be a steward. You got to be diligent. I mean, anything that says otherwise, in my opinion, is basically BS. There's no magic sauce attached to the insurance policy. It's very simple and very basic. It's a product that's always had the same fundamental features. Now, we've got more tweaks and some customizations now in 2026 that you couldn't do back in 1987 or 88. But the contractual elements, the contractual guarantees are all the same. They're identical. The difference is that the product is the insurance policy. Infinite banking is the concept. It's the strategy. It's how you implement this in your life. It's not about the policy. It's about you, the consumer, you, the banker, turning the tool into a system that actually benefits your family. That's what IBC is about. Look, if you run a business, you know how critical it is to control your cash flow. Leave a comment with the financial hurdle that you're facing right now. Your insights, your questions, they inspire us to create episodes that give you real strategies to grow your business on your terms. Now, let's go back to this history lesson a little bit. Now, the ad, again, we're talking about 38 years ago. A couple other key things that we see. Some life companies had placed ads such as this, all right, similar type, in various major newspapers and magazines, causing the sales of single premium, I repeat, single premium, whole life insurance policies to soar. The end result was that the entire financial industry, and specifically whole life product, came under federal scrutiny. That doesn't sound very good. Turns out it wasn't. Okay. And so, it goes on a little bit. So the key thing is, like, one person does it and other people do it. And that's that same thing that happened with the insurance companies in their news articles and the magazines is what we're seeing online. The same correlation taking place. 40-year cycle, generational cycle, history repeating itself, just repeating itself in the new medium that we have to work with today. So I'm flipping to the next page, a couple things. It kind of mentions how two wrongs don't make a right. And what you can see is how the reputations can be ruined by institutions and disgraced. As usual, government intervention only makes matters worse. I got a good kick out of that. More often than not, we discover that government intervention is the primary culprit, as it was in this particular case. The end result of this entire ordeal was that the once invincible, air quotes, whole life insurance product that was so maligned that it bears a stigma that lingers to this day. Now, we're seeing that trend change. I think we have in the last number of years, maybe me more so than others because I'm heavily involved in it. But we're seeing a huge rise in the sale of whole life and the placement of it. And granted, some of that's really good. Some of it isn't, depending on how it's sold. But it's good to see it coming back into favor. And some of the things that put it out of favor, again, there's more in here that had to do with interest rates. There was a huge rise on the ideas of buy term and invest in the difference at that time. So there's more history in here that you can unpack, which is all very, very good. These historical events are important because they help explain why those who truly understand the unique benefits of dividend-paying whole life continue to defend its merits vigorously. I'm one of those guys. Jason's one of those people. The type of content we produce has a lot to do with that. And then we have other really good, amazing people. Highly encourage everyone to tune in and subscribe to the Nelson Nash Institute YouTube channel. All right. Defend its merits vigorously despite its often misunderstood image. What we must not forget is that the practice of IBC using life insurance continues to afford us financial freedom. But with this benefit comes responsibility. See, I'm kind of like, I like Spider-Man comic books. I was always a big fan of Spider-Man because with great power comes great responsibility. And I was sharing this with someone who was in my office the other day. I've got this I'm responsible name tag that I've had in front of my desk for basically the last 25 years. And we have to recognize that we as individuals have a responsibility. We have to take it for our own personal finances, whether you're doing IBC or not. It's your money. It's your finances. No one will take ownership over it better than you, but you have to recognize that you need to take that ownership. That's part of our model, is helping you be in the driver's seat of your money. But with this benefit comes responsibility, especially in how it is marketed to the public. Providing guidance and educational insight in this particular area is one of the most important reasons for the establishment of the Nelson Nash Institute, along with authorized IBC practitioners program for financial professionals. Now, I'm truly blessed. I've had the pleasure the last 3 years to be part of the inaugural practitioner council. So it's a group of people hand selected by the board of directors of the Nelson Nash Institute. And the purpose is to help advise and engage with the board on initiatives and activities that can help support our membership of authorized practitioners, the vision of Nelson Nash of the Institute into a bigger and brighter future. How do we make and plan our next best decade? We've made a lot of headway in the last 3 years on that. One of the key things that we've done as a group, a shout out to Bruce Wayner, to Mary Jo Ehrman, to Tim Urich, shout out to David Stearns, to Lee Barganier, to Carlos Lara, everyone who's been involved in that. We've launched an incredible program now over the last 2 years called the Coaching Academy. It's designed for people who are looking at getting into the space, or they've gotten licensed and they want to now grow a business like this. It's a combination of experienced advisors, brand new people, where you get to come to a 2-day event. We do a deep dive into Nelson's book. You learn how to interpret and understand how to use that book really powerfully. You get a lot of your questions out. You learn a little bit about some basic marketing, some creating your own niche, and you have a great engagement in a small group of people, and you build really powerful lifelong relationships. Phenomenal program. We have people coming through it. We're running about 2 to 3 of those a year, and it's absolutely amazing. It's great to be a part of, and it's exactly what we needed in the industry. So that's just one example of tying back to this article, this chapter that Carlos wrote years ago, and how it is important to provide that guidance and educational insight so that when we're marketing and speaking to the general public, we are saying not only what's true, but also we're cleaning up and helping our language get better, which is something that Jason and I know we really attempted to do here on the podcast. And so hopefully you enjoy that. Now, they did end up changing the tax code. This is kind of where the MEC rules and everything came in. A lot of people talk about that online. I'm not going to get into all those rules. It's not critical. It has to do with tax exempt room and limits of a policy. Okay. The key thing is that IBC in whole life wasn't a gimmick. It was legitimate. Now, in Canada, we had some similar things, some parallels that happened in the 1980s. It's not exactly the same, but there were overlapping things in some tax reform. One of the things that happened in the 80s, though, is during the Trudeau government of the late 70s and the early 80s, there was a lot of inflation taking place, and there was some trouble with government coffers. They were looking to raise revenue for tax revenue and stuff. So there was really serious proposals about taxing life insurance death benefits. And the result, to summarize everything, is that the industry was up in arms. The people weren't up in arms. Newspaper articles were going out where they were calling it the widows and orphans tax, because you would have little widows, little ladies who are, because usually men go first statistically, and they're left behind with nothing. You're going to tax everything that they're getting, and they need that to survive. And what about the orphans? What about the kids? They're not going to have anything left over. So they call it the widows and orphans tax, or they call it the kiddie tax, KIDDIE, like kiddie tax. There was a number of things. And so the public backlash was really, really big. And Canadians basically weren't having it. They were furious. The lobby, the insurance lobby, kind of went to work. And essentially the government ended up backing off in the situation that happened. So death benefits stayed tax-free as long as you have a properly named beneficiary. And, there's little reasons that it could go sideways. It's very rare, but there are some things that could mess it up. But for the most part, death benefits are tax-free. But they did tighten the rules. And so policies issued after December 1, 1982. So again, this is where grandfathering comes in. Same thing in the United States and in Canada. When they made a change, what has been consistent in general, and that could change in the future, but in general, anytime they've made a major change like this to something from governing rules, tax rules, or whatever in the life insurance industry, they get grandfathered. So whatever happened before stayed in the old rules. Anything going forward new is now under the new rules. That's generally what happens. Could they change in the future? It's always possible. The government seems to have a lot of power these days, so who knows what they'll do. But essentially, they changed and modified the ACB calculation in Canada, and they modified it where policy loans were now considered a disposition of the policy. So you can do cash withdrawals, you can have dividends and take them as distributions rather than putting them back into buy pay division. There's lots of options available that people don't realize, but those things are considered dispositions, and dispositions have taxable events. And so policy loans, when they go over the adjusted cost basis based on their updated calculation, now could create a taxable event in the future, which we talk about. It's very important. We talk about that in Canada. In fact, that's why for our Canadian clients, if you're listening, we always recommend, very important, you go and revisit episode 100 of our podcast. We do a deep dive into this. It's 1 hour. You only need to watch about 30 minutes. Okay, entrepreneurs, this content is built for you. Comment below. Tell us what money topic you want to hear more about. Your insights and questions inspire us to create the content that coaches you to build lasting control and growth on your terms. I draw out on the screen everything that we talk about. You can see visually. We go over strategies and ideas, how to maneuver and update it and what you can do. There's like collateralization options. There's other things that you can do to control the experience. So we want to make sure our clients are informed and educated so that they can choose the path that's right for them. So episode 100, I let my clients know, is actually annual required homework. If you know that you have the possibility of a problem 20 years from now, 25 years from now, well, when do you want to plan for it? Well, you start planning for it all the way along. You don't wait until the problem is there. There's a difference between being proactive and reactive. And that's our focus, is to help people be more proactive. Okay. So now, again, understanding this difference is important for Canadian clients. It's also important for Canadian advisors. So if you're an advisor watching, we'd encourage you to also have good clarity on that and make sure you're able to explain it properly to your clients. Now, the key thing here is that IBC is not a gimmick in 2026. It has never been a gimmick, and whole life insurance isn't a gimmick. It's fundamentally sound principles based on a fundamentally sound insurance contract. Now, overall, all these changes has an impact in it. If anything, to some degree, some of these changes have even over time allowed us to make things even better. A couple other items I want to highlight in here in this article. So I'm going to kind of go to the bit of the conclusion page. The 1988 committee's efforts in all these changes and discussions around tax rules going back to the States were successful in reclassifying the single premium whole life product from pure insurance to a tax-preferred investment account. However, for all practical purposes, the dividend-paying whole life product remained intact, complete with all of its multidimensional benefits. Now, this is the cool thing. A lot of this had to do with an actual product called a single premium life. So it was a one premium, one-time deal. You didn't have to ever put another dime into it. Typical whole life has a scheduled list of premiums contractually obligated. But paid up addition premiums, which you can now do as a flexible option, your choice as the policy owner, fundamentally a paid up addition premium is a miniature version of a single life policy. It's just being stacked on and added to the existing policy. So it's kind of interesting how these things intersect with one another. When a properly designed and funded dividend-paying whole life policy continues to have the same favorable tax treatment, the same accessibility to its cash values, safety, privacy, diversification away from volatile markets, because it's not market correlated. It's a contract. It's contract guaranteed based on how it's managed and administered. It has guaranteed growth, stability, control, and numerous other financial advantages that have made it so appealing. Now, we talked about a lot of those events in our last episode when we went over the perfect investment criteria. Both historically and in particular, even after the 1986 Tax Reform Act, it still continues to provide the flexibility to sequester, in other words, to park, to separate, to warehouse, all right, small or large amounts of money inside of it for maximum protection and financing purposes. Great line. Love that line. In addition to providing the peace of mind that comes from protecting one's beneficiaries in the event of death. So you get amazing, unbelievable insurance that grows all the time. You get a place to sequester and park and warehouse money and have it in an environment that has growth, stability, control, and a whole host of other advantages. And it's attached to a tax-free death benefit. It's pretty solid. Since IBC is the process of using specially designed policies like this for superior cash management, safety, the members of the public, when ready to implement the process, are encouraged to visit the Nelson Nash Institute. I already made a plug for their channel. It's a great channel, lots of great content down there. And seek out the guidance from one of our authorized practitioners. Okay. Now, skip ahead a little bit here. We must not forget that government is like the roaring lion seeking to destroy everything in its path. through excessive regulation when given the opportunity. Now, it's hard for me to contain sometimes my smile when I read something like that. I got goosebumps when I read that, and it really connects with me. Let's not give government an irresponsible reason to come looking our way again with sensationalizing and misleading advertising. No matter how too good to be true IBC may seem, it is not a financial gimmick and should not be portrayed as such. That is the crux of it. That's the key elements. And that's what I really wanted to hit home here today. There's tons of key advantages. We know we got a boom bust cycle that we got to deal with. We know we need a place to park money where we can have maximum control. We know we're going to need liquidity. We know there's going to be volatility. We know there's going to be geopolitical strife. You need a safe haven for where you can park and preserve capital, access it when needed, and allow it to continue growing on autopilot when you're not at the same time. And we also know at some point in time, we're all going to be talking about one another in the past tense. Graduation day will occur. Are you going to have an influx of capital show up to solve problems for the loved ones and people that you care about left behind? Well, if you live a really long life, which I hope is the case, most people won't have any coverage unless they do this concept or strategy or have proper insurance in place. So you need to combine all these things together, and what you do create is a pretty beautiful looking system. So the IBC strategy creates control, has that uninterrupted compounding potential, non-inflationary loans. It survived scrutiny from both sides of the border across a variety of different things, still works. And look, if you've been skeptical because it sounded too be true, I get it. It's possible. There is some great features here. But go ahead, drop us a comment about what that skepticism is. What was your biggest objection when you first learned? Or maybe you're still learning and you're not sure and you have questions. Leave a comment. Now, if you want the full story for everything, you want to do a deep dive into that history lesson, I do encourage you to pick up a copy of The Perfect Investment from the Nelson Nash Institute. It's not something we sell at our bookstore presently, but you can certainly get a copy. I'd probably get it on Amazon. And there's some great stuff there. That's all from chapter 4. Now, at the end of the day, you are the banker in your life. If you're abdicating that responsibility to some third party, that's on you. You have to make the decision that you want to control the environment, and you want to start slowly and incrementally bringing that control back at the you and me level. That's where we believe it should be, and we want that for you. So, poof, you're going to see some more content that just showed up. It's great stuff. Might even be the last episode. Go ahead and click through that, continue your journey of learning, and we will see you on the next one. Go ahead, take a look at the next episode down below, and make sure you get a copy of our book, Cash Follows the Leader. Go to cashfollows.com and get a free copy right to your inbox.